Welcome to Trading Pro. In our previous courses, we've already discussed trend pullback patterns. Today, we begin studying trading ranges. This video mainly addresses two questions. First, how are trading ranges formed? Second, what are the characteristics of trading ranges? Let's start by examining a few case studies of trading ranges. The first case involves a 2-hour chart of gold. After the price exhibited a two-stage downward strong trend, the market entered a state of trading range. The second case still involves gold over a 2-hour period, which formed an upward channel and the price entered a sideways range. The third case is a 4-hour chart of crude oil. After a two-stage downward strong trend and a strong upward adjustment, a trading range followed. From these cases, we can observe that the market usually has a rapid movement before entering a state of trading range. This rapid movement could either be a strong trend movement or a strong pullback of the trend. Regardless of the specific movement, the critical point is that the market always first exhibits a rapid movement. Recall what we've learned previously. Why does the market form a trend movement? Take the downtrend in this case as an example. During this downward movement, the major market participants are in agreement. They believe the price should go lower. Hence, the main bearish traders continuously increase their short positions, while the main bullish traders would close out their long positions, choosing to stand by. They would only start buying and re-enter the market when the price falls to their anticipated level. When the main market participants hold the same view, in this case, they all believe the price will drop to a lower position, the resistance to price movement decreases. Here, the resistance to a decrease is reduced because the bullish traders are temporarily observing from the sidelines, resulting in a trend movement. However, what happens when this downward movement reaches the level where bullish traders intend to enter the market? The reason for the smooth downward trend movement was that the main bullish traders temporarily refrained from participating in the market. But now, the price has reached their anticipated buying position. This expected target position might be a crucial support level. It could correspond to a significant support level on a larger cycle, or it might be determined by the appearance of selling climax, a phenomenon where the downward movement has reached a peak and the bearish momentum is exhausted. Alternatively, it could be determined by some unknown indicator or algorithm that they've used to judge it's a good time to go long. We don't need to find the exact reason. What's important is that buying power has started to appear in the market. We need to extract this information from the candlestick chart. As a side note, why do we not need to dig deep into some questions, but simply read the information given by the candlestick chart? Let's take gold as an example. There are countless large-scale participants trading gold worldwide, such as central banks of various countries, the world's largest financial institutions like Swiss banks, or the world's 4 major investment banks, Merrill Lynch, Morgan, Goldman Sachs, and Citibank. Additionally, large commercial enterprises, various funds and investment banks, and even the world's top wealthy individuals are buying gold, among many others. These numerous large-scale participants are competing in the market, and the result of their competition is the direction chosen by the market. Can we figure out which tools each institution is using to analyze the market? Who is using fundamental analysis, and what data are they analyzing? Who is using technical analysis, and what analysis tools are they using? We can't possibly understand the thoughts of each main participant. It's unrealistic, but their traces and results of competition are all shown on the candlestick chart. Therefore, I always emphasize that all we need to analyze is the information that the candlestick chart provides us. This leads us to a new question. Why do many people always believe there are market makers out there reaping profits at the expense of retail investors? With so many large institutions participating in the market, would the capital of U.S. small retail investors even matter to them? It's like dropping a pebble into the ocean. If you're always blaming your losses on market manipulators, this reflects two things. Firstly, you're avoiding reality and refusing to accept that you're losing money in the market due to your own lack of ability. Secondly, it could be that the assets you're trading are of such a small scale, without the tug of war between the bulls and the bears, that they're entirely controlled by market manipulators. If you like participating in such assets, then you can't blame anyone for your losses. Let's return to the chart. How do we determine if bulls are participating in the market? By looking at the details of market trends. First, we see a selling climax in the market, indicating exhaustion of bearish momentum. How can we identify a selling climax? Initially, the price underwent a rapid decline here. After a minor pullback, it plunged rapidly again. A rapid decline following another rapid decline is indicative of the exhaustion of bearish momentum. Here we have two strong bearish candlesticks without much complex pullback. The market continued its downward trend. This is the nature of the market. When the decline is too rapid, it often faces the risk of exhausting bearish momentum. After the selling climax, the market went through a simple pullback, and after a slight adjustment, there was a downward false breakout. Looking here, the price point of the previous wave, which is the extreme value of the previous trend, experienced a false breakout. A false breakout refers to the market lacking follow-through power after a breakout. In this case, after the downward breakout, there was no follow-up bearish power. With the selling climax and the occurrence of a downward false breakout, many leading bears will start gradually taking profits. At the same time, leading bulls, capturing this signal of weak bearish power, naturally seize the opportunity to build positions and enter the market. Can we say the bulls are dominant in the current market? Of course not. If the bulls were dominant, the price would have broken through by now. Can we say the bears are dominant? No, because we see that in these nearly 100 candlesticks of sideways movement, the bears haven't been able to suppress the price. Both the bulls and the bears are continuously participating in the market, with the price moving within a range. The market starts to become uncertain. We say that the probability of the trading range breaking out in either direction is 50-50. But to be strict, the probability of a breakout in the direction of the trend is slightly higher. However, this slight probability advantage is negligible. We should focus on observing the range itself. During a trend, bulls and bears agree on the market direction. One side continues to enter while the other temporarily exits and observe. In a range, bulls and bears disagree. The side following the trend wants to push the price to the extreme point of the trend, while the contrarian side thinks the current price is worth entering and continues to do so. From another perspective, a trading range is a region where both bulls and bears see trading value. A trend is when the market is looking for this value region. Within a consensus value region, bulls and bears continue to participate. When one side no longer sees value in the current price, they choose to temporarily exit and observe, breaking the range. The market then enters a trend to find a new price region. Bulls and bears then participate vigorously in the market again, forming a new trading range. There are only two types of price movements, trending and non-trending, or in other words, trend and range. The market breaks out from a value area, seeks a new value, breaks out again, pauses, and this cycle repeats. This is the basic principle of price movement. If, after the price breaks out from a value area, it runs a great distance before forming a new value area, we often refer to this as a significant bull market. If it's a decline, then it's a significant bear market. This refers to a strong trend that lasts for a long period of time. However, if the price breaks out from a value area, doesn't run too far, pauses and forms a new value area, then breaks out again to return to the original value area. This just means the market has transitioned from a smaller range to a larger trading range. Both bulls and bears don't have a unanimous view on the market direction and are still actively participating within the large value area. Rising channels or falling channels are simply sloped trading ranges. Both bulls and bears are actively participating in the market within the channel. One side has a slight advantage. Many novice traders have a misconception. They feel that in a rising channel, the bulls have a significant advantage. In a falling channel, the bears have a significant advantage. However, using simple logical reasoning, it's easy to prove that this view is incorrect. Take this falling channel as an example. If the bears had a significant advantage, the price should have directly broken down. but in reality, it couldn't break down. Each time the price reaches the channel line, we can see that the bulls are actively participating in the market, pushing the price back up within the range. Therefore, it's best to treat these channels as slope trading ranges. How do we determine the formation of a range? Let's start with our first case study. This is a 6-hour chart for the New Zealand dollar against the US dollar. First, there was a strong bullish push, driving the bullish trend to its extreme. The final push took the form of a channel, which we won't draw in detail here as it may look messy. After this bullish trend was pushed to its extreme, the market experienced a significant pullback. Actually, we found that this pullback is a retest of the channel starting point, which is a point I often emphasize. Then, the price retested the channel. After the significant pullback, the bullish trend continued. However, this continuation didn't clearly break the trend direction. When the breakthrough in the trend direction failed, the price underwent another adjustment. This adjustment found support at the previous wave's point. At this point, when the price again finds support at the previous wave's point, we consider that the market has formed a potential trading range. The market then continued to operate within this range. A side note, if this adjustment had not found support at the previous wave's point and had instead broken through significantly, it would be a potential reversal pattern, which we will discuss in our reversal chapter. Now let's take a look at our second case study, again using the 6-hour chart for the New Zealand dollar against the US dollar. Initially, the market had a rapid fall, followed by a significant adjustment. After this significant adjustment, the breakthrough in the trend direction failed. Specifically, the downward breakthrough failed. It didn't even test the extreme point of the downward trend. After the failed attempt to test and break through the low point, the price underwent another significant adjustment. This adjustment found resistance validation at the point of the previous wave. This means that the price fell again upon reaching the point of the previous wave. At this point, we consider that the market has formed a potential trading range. If, however, the price had not found support at the previous wave's point and had directly broken upwards, then the market would no longer be a potential trading range, but a potential reversal pattern instead. The two cases we just discussed are quite standard and straightforward. However, in actual markets, we will encounter various variations. Overall, the formation of a range involves 3 steps. First, there must be a trend pullback, preferably a deep one. Second, after the pullback, the trend should not be able to successfully break through, indicating weakening trend energy. Third, the next pullback should find support at the previous wave's point. If it doesn't find support at this point and directly breaks or breaks through the previous wave's point, it would be a potential reversal pattern. When these steps occur, we consider that the market has entered a potential trading range. Please note the word potential. It doesn't necessarily mean the market will enter a trading range, but that it has the potential to. We consider it a potential trading range because the trend energy has decreased, and there's been no counter-trend breakthrough, leading the market to pause at this price range. Furthermore, bear in mind that standard, perfect trading ranges are hard to come by. Most ranges are irregular, and you must understand this point. Now, what characteristics do trading ranges have? Price movements have inertia. Remember this point as it is crucial for both your chart reading and trading. Whether it's trend movement or range movement, the market tends to maintain its current movement state. Hence, in clear trends, most potential reversal patterns fail and evolve into trend continuation patterns. That's why I don't recommend beginners trade reversal patterns. Many people like to trade double tops and bottoms, head and shoulders tops and bottoms. But you'll find that many of these patterns fail and eventually evolve into trend continuation. This is because the market has inertia and tends to maintain its current state of movement, and trends tend to continue. Similarly, in clear range movements, most breakthroughs of the range will fail, turning into false breakout. This is because the range is also a state of market movement, and the market tends to maintain its current state. This is a critical point to keep in mind. Let's look at this example on the 1-hour gold chart. The market starts to form a potential trading range here. How do we determine this? First, there was a strong bullish push, followed by a significant pullback. After the deep pullback, the bullish trend continued, making a false breakout at the previous wave's high point. Then, after another significant pullback, the price found support at the previous wave's low point. We consider this to be the formation of a potential trading range. The subsequent market movement verified our judgment of this range. Once a range is formed, it tends to last for a long time, and it contains many false breakouts, such as here and here. Regarding how to engage in range trading, it can be simply divided into two forms. One is intra-range trading, also known as selling high and buying low, or trading false breakouts within the range, which involves trading when the price returns inside the range after a failed breakout. These trades are based on the assumption that range will continue. The other form of trading is trading range breakouts, not expecting the range to continue, but assuming the market has transitioned from a range to a trend. We'll go into detail about these range trading methods in next lessons. That's it for today's video. And if you like this content, please like, comment, and subscribe so you won't miss out, and I'll see you in the next video.